Wendy's was supposed to be the comeback story of fast food. The little burger chain from Ohio. Wendy's is one of the most interesting stories in fast food because just a few years ago, they were winning. Back in 2021, headlines were calling Wendy's the #2 burger chain in America, officially passing Burger King. That was a huge moment. It looked like Wendy's was finally breaking out of the middle of the pack. But fast forward to today, and the headlines look very different. Now we're seeing reports of store closures, franchisees under pressure, and Wendy's planning to shut down 5 to 6% of locations in the first half of 2026. So what happened? How did a company that was gaining ground suddenly start losing it? To understand that, we need to zoom out. Let's start with the stock, because the market usually tells the story before the headlines do. Over the last 5 years, Wendy's stock has dropped over 66%. That's not a correction, that's a collapse. And it's not just the stock price. Wendy's market cap has fallen from over $5 billion to levels we haven't seen since 2008, going as low as almost $1 billion in a valuation. This is the market saying one thing very clearly. Wendy's is not the company it used to be. But why? What changed inside the business? When you dig into the financials, the story becomes clear. Revenue has been flat. Margins have been shrinking. Same-restaurant sales, one of the most important metrics in fast food, have been inconsistent and most recently negative. And then there's the dividend. Wendy's raised its dividend aggressively, eventually paying $1 per share, which pushed the payout ratio above 100%. That means they were paying out more than they were earning, and eventually they had to cut it. That's usually a sign of a company trying to keep investors happy while the fundamentals weaken. And then you have the cost cutting. Articles started circulating about Wendy's switching to shredded lettuce, and customers speculating about the changes to the chicken quality. Whether those changes were real or not, the perception was clear. Wendy's is cutting corners and focusing on dividend payout to shareholders versus the consumer. And in fast food, perception is everything. To really understand Wendy's struggle, you have to look at the competition. You have to look at their competition of McDonald's, Chick-fil-A, and Five Guys. McDonald's wins on scale. Five Guys wins on premium. And Chick-fil-A wins on quality. So where does Wendy's fit? They're not the cheapest. They're not the highest quality. They're not the fastest. They're not the premium option. Wendy's is stuck in the middle. And in business, the middle is the most dangerous place to be. This is the core problem. Wendy's doesn't have a clear identity advantage. But the story isn't over because Wendy's is trying to rewrite the next chapter. In May of 2026, the company brought in a new CEO, signaling a major shift in direction. They're revamping the spicy chicken sandwich, launching new items like jalapeno fries, and trying to rebuild the menu identity that made them famous. There are even reports of Wendy's exploring the idea of going private, a move that could give them the freedom to restructure without Wall Street pressure. This could be the turnaround moment Wendy's needs, or it could be a sign of deeper problems. So here's the real question. Is Wendy's about to stage a comeback, or are we watching the final chapters of a brand that lost its way? The last 5 years tell a story of momentum gained and momentum lost. A company that once challenged the giants, now struggling to define itself. Both new leadership, new menu changes, and the possibility of going private, the next chapter could look very different. So what do you think? Is Wendy's heading toward a happy ending, or is this the beginning of the end? Thank you for your time. Please feel free to like and subscribe for more content from my channel. Thank you, and have a great day.